Welcome to Section 5 of our ASC 718 training series on stock-based compensation. In this section, we will explore three critical concepts that shape how companies measure and record compensation expense: forfeiture accounting, performance conditions, and market conditions. These topics sit at the heart of getting SBC accounting right. By the end of this section, you will be able to distinguish between the two forfeiture accounting policy elections allowed under a SC 718, apply the period-by-period accrual model for performance condition awards, explain how a market condition is incorporated into grant date fair value, identify when expense reversals are required versus prohibited, and contrast the very different accounting treatments for performance conditions and market conditions. A forfeiture occurs when an employee leaves the company before their stock award vests. When that happens, the unvested shares are canceled. Under a SC 718, any compensation expense that was previously recognized for those canceled shares must be reversed. The logic is straightforward. Compensation expense should only be recognized for service that was actually rendered. If an employee walks out the door early, the company did not receive the full benefit it was paying for, so the previously recorded expense comes back off the books. ASC 718, as amended by Accounting Standards Update 2016-09, gives companies a choice between two forfeiture accounting policies. Under the estimate method, a company reduces its compensation expense each period by the percentage of awards it expects will be forfeited before vesting. That estimate is revised every reporting period, and a cumulative catch-up adjustment is recorded when the estimate changes. Under the actual method, a company records 100% of compensation expense as though all awards will vest, and only reverses expense when a forfeiture actually occurs. The estimate method is required under IFRS, while the actual method is only permitted under US GAAP. Each method has practical trade-offs. The estimate method provides better matching. Expense reflects only the awards that are expected to vest, which is conceptually more accurate. However, it requires companies to maintain and update forfeiture rate assumptions every period, which adds complexity. The actual method is simpler to administer because no estimates are required. The downside is potential volatility. If a large group of employees departs at once, a significant reversal of previously recognized expense hits the income statement all at once. Companies with high employee turnover and large grant programs will generally benefit most from adopting the estimate method to smooth that volatility. A performance condition is a non-market vesting condition, something like a revenue target, an earnings per share goal, or an EBITDA threshold that must be achieved for the award to vest. Here is the critical distinction. Unlike market conditions, performance conditions are not baked into the grant date fair value. Instead, they affect the number of shares the company expects to vest, and that number is updated every single reporting period as performance evolves. The grant date fair value stays fixed. What changes is how many shares you multiply it by. At the grant date, management estimates the probability that the performance target will be achieved and begins accruing expense for the expected portion of shares over the service period. The formula is the grant date fair value multiplied by the expected vesting percentage, multiplied by the fraction of the service period that has elapsed. Each subsequent reporting period, management updates that probability estimate based on current performance. Then a cumulative catch-up is calculated. You figure out the total expense that should have been recognized from day one through today at the new probability, and you record the difference between that cumulative amount and what has already been recognized. When the performance period ends, one of two things happens. If the target is achieved, the award vests, and any remaining unamortized expense is recognized in full at that point. If the target is missed, the award does not vest, and this is important, all previously recognized expense is reversed in full. There is no partial expense credit for the years of service the employee rendered while working toward a target that was ultimately not met. The entire cumulative accrual comes off the books. This is one of the starkest rules in SBC accounting, and it is a direct contrast to how market conditions are handled, which we will cover next. A market condition, such as a stock price hurdle or a relative total shareholder return target, often called TSR, is treated entirely differently from a performance condition. Instead of adjusting the number of shares each period, the probability of achieving the market condition is modeled directly into the grant date fair value, typically using a Monte Carlo simulation. Because there is a chance the target will not be met, the resulting fair value is lower than it would be without the condition. And critically, once that grant date fair value is set, the accounting is locked in. The actual outcome of the market condition does not change the expense recognized. This is the most counterintuitive rule in SBC accounting, so it is worth stating clearly. If the TSR target is met and the employee completes service, you recognize full expense. That is straightforward. If the employee forfeits before vesting, you reverse all previously recognized expense. That is also logical. But here is the rule that surprises people. If the TSR target is missed entirely and the award pays out nothing, you still recognize the full compensation expense over the service period. There is no reversal. Why? Because the probability that the target might be missed was already factored into the lower grant date fair value produced by the Monte Carlo model. The company paid a lower accounting cost up front in exchange for accepting that risk. Placing these two condition types side by side makes the contrast clear. For a performance condition, the grant date fair value is fixed, and what changes period to period is the number of shares expected to vest. If the performance target is ultimately missed, all recognized expense is reversed. For a market condition, the share count is fixed, and what changes at grant date is the fair value itself. It is set lower to reflect the probability of non-achievement. If the market target is missed, expense is never reversed because that risk was already priced in. The one rule that applies equally to both. If the employee forfeits before vesting, all previously recognized expense is reversed regardless of condition type. Consider a practical example. A company grants a TSR award that vests after 3 years if the company's stock return ranks above a peer group median. A Monte Carlo simulation produces a grant date fair value of $8 per share, lower than it would have been without the condition, because the model priced in the chance the target would not be met. 3 years later, the company's stock underperforms and the award pays out nothing. Despite that outcome, the company records the full 3 years of compensation expense at $8 per share times the number of shares originally granted. The lower fair value is the mechanism that accounts for the missed target, not a reversal of expense. Let us close with the essential takeaways from this section. Forfeitures always result in a reversal of previously recognized expense, and companies must elect either the estimate method or the actual method and apply it consistently. Performance conditions affect the number of shares expected to vest, not the grant date fair value, and are updated every period with a cumulative catch-up adjustment. If a performance target is ultimately missed, all cumulative expense is reversed. Market conditions work the opposite way. They are incorporated into the grant date fair value through a Monte Carlo simulation, and if the market target is missed but service is completed, there is no reversal. The probability of failure was already priced in. Thank you for completing this section on forfeitures, performance conditions, and market conditions. Thank you for watching. Subscribe for more training from P&J Group.